Welcome to Stock Talk with Nico Kritikos. Today, we are going to be looking at my top five stock picks for the month of September 2025. All of these stocks I have positions in, and most of them I just started buying in the last week or so. But we are going to get started here with Salesforce. I bought 8 shares of this at an average cost of $244 a share. And as you can see, the stock is not only down over the last couple months, but when you look at the last 5 years, it's pretty much been flat. I mean, it's pretty much trading at the same price it was 5 years ago. So when you consider the fact that their numbers, like their net income and their revenue, let's look at their numbers here on Qualtrum. You can see that they've come a long way. I mean, the numbers are not the same as what they were doing 4 or 5 years ago. So here, let's go back to 2021. They're doing $21 billion of revenue and they're doing $4 billion in net income, which was actually a very high number for that year. But I mean, you look at where we're at today, where we're doing, over $6 billion in net income. And let's go to trailing 12 months here. The revenue's over $39 billion. The net income is now over $6.5 billion. So this, I mean, and the argument, the counter argument to this would be that the growth rates are down, which that may be a valid concern, but I don't think that means that the stock should be flat for 5 years. So, I mean, we're looking at a P ratio of 20 right now for 2025. So this is just one where, I mean, this is a solid company that's growing. And you look at the last couple years here, I mean, look at the difference between 2023, they only made $200 million, and now they're doing over $6.5 billion for the trailing 12-month period. So I think this is a stock that could, go up quite a bit from here. And I don't really think there's a lot of risk. I don't see this as a risky company. So that's why I like Salesforce. And, if the stock drops more, I'll probably buy more. My philosophy typically is I start the position, and then if I end up being down 15%, then I buy more shares. If I'm only down 5 or 10%, I normally don't just because that number is too small. Typically, I feel it's best to, add shares when you're down at least 15%. Um, but we'll see what happens. I think this is one where it's going to go up from here. I don't I would actually be surprised if we saw it go too much lower. So that's pick number one. Then we get pick number two. This is a new one for me. And to be honest, I looked at this one the last probably at least a month or two. I've been looking at this and I just said that this one's not for me. They're struggling and there's too much competition. And I don't know if this is a stock that can turn around, but over the last couple weeks, I mean, the stock has continued to fall, right? I mean, just we had another huge drop. I think I was looking at this. I was probably looking at this when it was around $200 a share, and I was like, it's okay, it's a possibility. But then once it had this bigger drop here in September 4th, and it got down to about 160, then I'm thinking, okay, now the stock is a lot cheaper, and the P ratio is so cheap. We're looking at a P ratio of about 11 on this one. So you compare it to other stocks like Nike or like I forgot if it was, I think it's Macy's that I looked at. Let's look at Macy's real quick. You look at these other, companies that are in this space, and like Macy's is a great example. I feel like this is worst case scenario, right? Look at Macy's numbers. Macy's numbers have the revenue's been trending down for years. The net income is not looking good. It's pretty much been flat. So for me, I think this would be like a worst case scenario for a stock like Lululemon. And the stock's trading at about 9 times earnings, which is pretty much what I'm paying. I'm paying 10, 11 times earnings for the stock. So I feel like this is worst case scenario. And if we were to look at, let's go over here and look at what do analysts have them doing. I believe the EPS is expected to jump quite a bit going into next year. Yeah, we're looking at, so I mean, the growth is pretty much, this year was a huge setback, right? We saw over $14 EPS last year down to only 12.9 expected this year, but then we're expected to jump back to 13.5. So if they can keep that momentum going, then the EPS is going to go back up, and I would think that the PE ratio should also increase because look at it used to trade at, around a 20 or so, right? Even up to a 27 in recent times. But now we're down to a 4 PE of 12. So again, is this company in the best place? Not really. I do acknowledge that they're struggling in some areas, but at the same time, when you look at how cheap you're getting the stock, I think it's very realistic for the stock to actually turn around, considering that this was, just a couple years ago, the stock was over $500 a share, and now I'm only paying 159. So I can easily see the stock turning around and getting back to a $300 plus stock at some point in the future. So that's just kind of my perspective on this. I mean, let's look at their numbers here. Let's go to what they're doing for net income the last couple of years here. And the revenue is still growing. I mean, obviously the growth rates have slowed a little bit, but look at the revenue is still growing. We're only paying $18 billion dollars for a company that's doing almost $11 billion dollars of revenue and net income now of 1.7 billion. So it's really not that bad. I mean, look at the last couple of years. The net income is still going up, right? Even if they're struggling a little bit in certain markets, the net income is still going up. It's really not that bad. It's not like Macy's or some of these other companies where they're losing money or it drops by 80%. The numbers are not that bad here. So I mean, look, this is also a great sign. The shares outstanding is decreasing. They're buying back shares. That's a great sign that makes me more confident in it. So to me, this one is just it's worth taking a chance on this one. It's worth the risk at this point because there's so much risk taken out of the stock now that I'm only paying 10, 11 times earnings. So that's pick number two. Pick number three. This is one that I've owned for a couple of weeks now, and that is Chipotle. As you can see, I'm down in this position because again, it's been dropping the last couple of weeks here. It's kind of starting to flatten, straighten out a little bit. It's of course it's possible that the stock falls another 10%, 5, 10% or something, but I feel comfortable buying into this because I think that with Chipotle adding more locations, um, and consumer demand, I think the argument out there right now, the idea that the consumer sentiment is bad, it's sure that's a possibility maybe in the short term, but in the long term, 6, 12 months from now, I don't think, I mean, that stuff doesn't last, right? The economy and consumer spending goes up and down. So this is one where when consumer spending gets back to a healthier place, Chipotle is going to benefit from that. Okay. As far as I can tell, most of the people I know, right, I think that the demand for Chipotle is still very high. I think people still love Chipotle, and the fact that in the recent, the last couple of years they've been adding the Chipotle lanes, I think that helps a lot. I personally love that as an addition to the restaurant. But the stock has come down a lot. I mean, you look at it now. Keep in mind for a company like this, the P ratio has been high. This is not a stock that trades at a cheap multiple, so you have to acknowledge that. But I even with that being said, I'm still confident that this is a stock that has upside potential. You look at the forward PE the last couple of years, we're looking at, anywhere from a 40 to a 60, 40 to 55 or something, let's say. But now we're down to a forward PE of 27. So that's not super cheap, but for Chipotle, it looks pretty cheap, right? The revenue growth is expected to jump from 7% to 12%, which is very good. And then the EPS is going from 1.1, 1.2 to 1.4. So the numbers look good there. I think it's just a matter of time before the stock goes back up. And same thing with how I talked about in the first company, where look at the last 5 years. Okay, we're at $38 a share. That's where the stock was at even going back to 2021, the stock was at $38 a share. Um, and of course, 2023, it was also trading at those prices. And so let's go look at where has Chipotle's numbers gone from 2021 to today. So 2021, they did $7.5 billion of revenue. Now they're doing over 11 and a half. Okay, quite a big jump there. Net income 2021, $650 million of net income. And now they're doing over 1.5 billion. Okay. So it's quite a difference. Again, the growth is probably slowed. They're expected to do 12% revenue growth, right? When last couple years, I mean, really, it hasn't even changed that much. The last 5 years, they average 15% growth. That's not that much different from 12%, which means the multiple should not be changing that much. So with me getting the multiple at this cheap, again, to me, it just makes sense to take a chance with this one. I'm willing to take on some this amount of risk for the potential reward because I think Chipotle is a great company with great food. So this one I'm happy to be a buyer of. Number four on my list is another restaurant. This is one that I've traded on and off. I actually own this. I believe earlier this year I sold out of my position, made some money. Let's see what happened. I think I sold. Let's see. Um, yeah. So I think I bought Chipotle. It had to be right here, April 2025, and then I sold it up here at about 190 or whatever. Now the stock is back down to the 160s, so I'm going to buy it again. If we look at the valuation for this one, we could see kind of a similar, again, I think with the restaurant stocks, I think they're being hit now because they're saying consumer spending is bad. But again, that's a short-term problem, so I'm not too worried about that. Forward PE of 22, which is again cheaper than anywhere it's been in the last 2 years or so. So I'm happy with that. Analysts have them doing EPS is expected to jump from 6.5, then 7.5, revenue of 9 to 10%. And I mean, this is one, I think this is a great one because there's always a line out the door. For years and years, there's crazy demand for this restaurant. And so I'm not too worried. You look at their numbers, revenue is always growing, net income, great trend growing here. So I'm happy to be a buyer. The valuation is on the cheaper side now. So, I think this is going to be a good investment. Finally, on my list, we have Airbnb. This is one I've made money with in the past. And again, you look at the last 5 years, it's basically flat, which is so disappointing if you bought the stock. Let me put it this way. I made a video talking about this, but if you're the person who just thinks long term and just thinks, okay, I'm going to hold, it's a long-term investment, I disagree with that philosophy for this reason. If you bought the stock anywhere in the first year, you wouldn't be up on your position right now, right? If you bought the stock anywhere around $150 a share, you'd be down in your position after holding for almost 5 years now. When in my situation with the current philosophy I use for investing, you buy when it's low and you sell when it's high. And you take it, you can sell it in pieces. You don't have to make drastic changes and totally predict the market. But at least when the stock goes down or it looks relatively cheap, you buy in, and then when it looks relatively expensive, you sell or you sell most of it. For this reason, because I've made money in this stock, I have bought and sold this stock multiple times in the last 5 years. Okay. But if you were somebody who bought and held, you would not make any money. So that is why, like, I remember buying the stock down here when it was like 90 bucks, I was buying the stock. When you do that and it goes back up to, let's say, 130, whatever, 140, however long you want to hold it for, then you sell, right? So right now it's not the cheapest. Like, I would not have paid this price for it back in 2023. But again, the numbers are different now. The revenue and net income is different. Let's look at where Airbnb's net income has gone the last couple of years. So revenue, $6 billion in 2021, and now we're at almost double that, 11 and a half. Net income, 2021, they were losing money, then they broke into $800 million Q1 of 2022, and now we're at $2.6 billion of net income. So again, the numbers are a lot better. Airbnb is one of those companies I think has a great business model, and it's also a company where I think they have a very strong moat and they have a very strong brand. When I book a trip somewhere, normally I'm thinking Airbnb, even though you have Vrbo and these other sites. Normally I'm thinking Airbnb. I think the platform is great. So this is one where, again, I'm happy paying this valuation when the stock has basically been flat for 5 years, even though the numbers have almost doubled since then. What does that tell you? That tells you you're getting a really good deal compared to where the stock historically trades. Forward PE of 25, when in the last couple of years, it's been trading at around 30. Okay. So those are my top five stock picks. One I've been looking at is Top Golf. This is like a bonus one. I believe it's Callaway. So I remember thinking when these two companies merged, Top Golf and Callaway, I remember thinking, wow, this is going to be great. They're going to have a huge, um, almost monopoly, right? Well, the complete opposite happened, and I'm so glad I didn't buy into the stock because I think I remember looking at it and saying, "Oh, the valuation's not good here. I'm not going to buy this," even though I thought these were two great brands that had a great future ahead of them. Well, I didn't buy the stock because the valuation didn't look good. And look where the stock has gone now these last couple of years. I remember looking at it and when it was in the 20s. Now we're at $9. And recently it was even as low as $5. Okay. So yeah, the sad thing is actually that okay, that's April when the market crashed. So the stock has actually almost doubled in the last 6 months or so, which means I'm buying it when it's a little bit up. But when you look at, I'm going to tell you my thesis here in a second, but I think the stock can get back to $20. So I think it's a good, there's a good chance that I'll double my money with this because so what happened was it looked like, so Callaway's a great brand. It looked like when they merged with Topgolf, the Topgolf craze kind of died out and the growth is just not there. Probably because it has something to do with the environment after the pandemic was different because people were looking for different things to do. But now, obviously the hype kind of died down for things like this. But the point is, these companies are separating, and it's supposed to happen. They're working on separating the companies with a spin-off or sale of Topgolf planned for late 2025 or 2026. So that should be coming out soon in the next couple months, and I think that's going to be a huge catalyst for the stock. The other good thing here is Callaway will continue to be the exclusive golf equipment supplier to Topgolf. So I think this is going to be a great thing for Callaway, and that's why I think the stock is going to go back up. So this one's kind of a bonus. As you can see, I have a order queued here. It should go through on Monday. But this is one I'm interested in seeing what happens. And those are my top 6 stock picks for this month. So thank you for watching, and I will see you in the next video.